predictions I have seen and something that I have argued as well, and what it means for you over the next couple of years. Yes, I know we are always focusing on the day ahead of us, but we also have to be very well aware of what is coming down the line. All right, so I know you're all here. I know you're excited. Good to see you, Doji. Good to see you, Longbox Larry. Once again, this is a day that when 9:30 comes around, you are the exit liquidity if you are not prepared. You have to know whether or not this is a safe market or if it is a trap day, and a little bit of attention being paid to our momentum reading today with our intraday figures falling negative again. We want to know exactly where smart money is positioning. I did a big thing yesterday about delta volume and focusing on MFI and the importance of it. I can't stress enough that these funds, that these organizations, these big institutions are very well hedged and positioned for whatever comes today when Jerome Powell speaks at 2:30. All right, on the macro side, just very simple. You already know the story here, but rates are expected to be held between 4.25 and 4.5%. Some voters may signal future cuts. And again, markets are going to be very sensitive to any dissent among the voting members of the FOMC, the Fed Open Market Committee, which has been meeting for the last 2 days. If you don't know what the Fed Market Committee is, you're better off. But the FOMC is in charge of helping to enforce the Federal Reserve's mandate by managing its open market operations and also managing the interest rate policy that largely hasn't mattered in 3 years, but for the most part, we are going to be so addicted to it. That's all we're going to talk about today. It's going to be great. GDP released today. I did not see the number yet because I have been digging into a handful of other things. We did see, let's see. God, it's got to be here. There we go. Found it. 10-year treasuries rise on strong GDP report ahead of Fed decision. The expectation was 2.9. We jumped 3% from April through June. This is why Jim Cramer was swearing on air the other day. So this surpassed expectations. And it brings that bigger question of, are we growing too fast? And resultantly, does the Federal Reserve have to keep rates elevated for a period of time just to ensure that we keep this economy from just whatever? We're still printing. We're still borrowing at 6% of GDP to print 3%. So let's calm down, everybody. All right. On top of that, mega cap earnings, Meta and Microsoft will be reporting. We have Apple and Amazon as well this week, but this is what will shape that AI positioning. And I always encourage you to pay very close attention to the SOXL, which is the bullish ETF for semiconductors. This had been choppy the last couple of days, but has seen a little bit of a rebound in positioning ahead of these earnings report. Everybody's saying good morning to one another. Anybody paying attention to good old Garrett? Who knows? It's okay. Not a big deal. Don't worry about it. What will be on the move today? So with earnings in play and with the Federal Reserve meeting today, high beta growth names are in focus. This is especially including Tesla. Historically, we have seen sharp reactions to dovish surprises, and often these stocks will fade up, rip up during the intraday, and then could potentially fade in that last hour. And we're going to talk about the 235 trade that we've discussed in the morning. Thank you, Doji. Thank you, P-Butts, for making me feel special. I appreciate it. Semiconductor plays and AI names, Nvidia, AMD, all of these will be in focus. We discussed this yesterday during our masterclass on beta, right? Higher beta stocks, bigger moves, more opportunity to trade reversions, more opportunity to trade intraday. You got Blake lined up with his monkey bars. You have my focus here on what's going on here with the volume weighted average price. It is going to be an active day. So you should be really excited about the opportunities that come. And if you're not a person who wants to, play in the high beta sandbox, just pay attention to the things that are rate sensitive. Utilities, home builders, consumer staples, healthcare, a lot of opportunity there. They tend to outperform in early phases of rate cut cycles due to the reaction in discount rates and bond yield competition. We'll be looking at these stocks, especially as we head into September. All right, 235 trade. It has not happened the last 2 trades, which has been interesting, which tells me, hey, we gotta hit red at some point, right? So what we are looking for today is a move off of the standard deviation lines that we always walk through it on TradingView. If you look at the S&P 500, the SPY, right, the SP Trust, what we're specifically looking for with deviation bands is a move where the markets kind of get locked up, and effectively what we're looking for is a move to the downside on the day. So we're looking for a move into the second, third standard deviation of price. And why does that matter? Well, it matters because what happens in these types of events, and has occurred in previous meetings, is that this gets kind of choppy and then supercharged, and we see some consolidation. And then based on just positioning, when the Federal Reserve makes its decision or Powell speaks, we have seen these moves to the upside. Now, I'm not saying that it's going to happen today, but I am saying that you want to be prepared for something like this, because if the position sets itself up, this has been a major pattern that we have seen in previous Fed meetings, where a short duration trade on a 0-date option that is in the money or at the money at the levels down here with a very tight stop can turn into a relatively sizable gain, because you may see the S&P 500 or the SPY move 3 to 4 points in a period of 15 to 20 minutes, and resultantly what you were buying in the money can absolutely run to the upside. But the other thing that I will warn is it's that last hour of the day. It's where the markets start to basically make the decision on what is going to be happening in the future, and whether or not institutions want to start to unwind their positions, or if they're going to be progressively bullish for the long term. So pay very close attention to that last hour. If we have gapped up, do not be shocked to see a rollover on the other side. And once again, I'm not saying specifically that this is going to happen. I just want you to be aware of it, that this has been a pattern that has happened in recent years, and just to make sure that you're not just blindly buying into any potential rally that comes on the backside of Mr. Powell speaking today. All right. You were in the Philippines and you got your test results back. I don't know. Okay. I hope everything's okay. All right. S&P 500 momentum. Intraday went negative today. And remember, we are looking at this pre-market, but we are seeing positioning ahead of the Fed meeting today. So once again, when we see this equation go negative, we turn our attention over to the FNGD. And right now, the FNGD, which is a leveraged ETN built around the debt of the Magnificent Seven stocks, the Netflix, the Googles, the Metas. What we're looking at is, in the event that this breaks its 20 and its 50-day moving average, the pressure of that negative momentum that we're talking about is coming from the top of the S&P 500. And that's where the real danger always lies. There are lots and lots of hedge funds, lots and lots of leverage funds, lots and lots of private equity groups, a lot of people who are all in the exact same trade, right? They're all in the exact same trade. So in the event that it is at the top of the cycle and we start to see that unwind in leverage, we can see that in the FNGD. What this is telling me right now, looking at this metric, is that the selling or the repositioning is happening at the bottom of the S&P 500. So we don't have a big warning signal yet, but I do just want to kind of put you on standby and let you know that we're in this position right now where the markets are effectively leveling out, or at least the S&P 500 is. The Russell 2000 is also showing some weakness as well, but for the broader part of this, the broader markets and the broader movements have been very, very strong in recent weeks, and resultantly, we're not at a 4-alarm fire yet, but it's just one of those things where I start to get a little bit concerned, because the selling pressure on the Russell 2000 is starting to accelerate, and as a result of that, I start to try to either take some gains or I start to reposition myself, and I have to start thinking about what a potential downturn would look like. Whether that comes in the next couple of days or it comes in the next couple of weeks. I will say that we do know that September is not a very good month for the S&P 500 and for the broader markets, but I also do want to note that it's going to take something significant to lead this market lower, to get that mindset to shift, once again from the institutions that they would be risk off because liquidity and capital remains very, very strong in the global markets. And on top of that, the thing that's very, very important to note is it's going to have to take some sort of policy shift that would ultimately lead to broader risk concerns. So I would be looking for that, not now, today. I would actually be expecting that out into the end of August when the Federal Reserve will be holding its symposium in Jackson Hole. What is stronger? Well, MNST, great company, great name, strength on that 20 and that 50-day moving average, improvement on all of the indicators that we are looking for. And this is the setup that we're looking for a multiple day swing trade to try to ride momentum. Consumer defensive based stock, obviously very good. I have a lot of focus on how do we get defensive in this environment. MNST, this is the type of thing that I'm looking to trade. I like the fact that that 20 and that 50-day moving average are about to converge. That's going to be very positive for a lot of behavioral-based traders. So I'm looking for another move up here, and it doesn't have to be that significant. I'm only looking for something to move up to 63.50 and get us back to where we were not too long ago. But I like the fact that this is just a very natural place to set a stop right here at that 20-day moving average around 60. What I would be looking for on a trade like this, buying the $61 call or buying the $60 call, going out 2 to 3 weeks, and then selling a call up at around the $63 or $64 level. Once again, Monster Beverage, buying an in-the-money call at around 61 or even 60, and selling a call out at either the 62.50. I don't have the options chain in front of me. Let me pull it up for you. MNST options chain. Here we go. All right, going out, let's say, let's just look at the 15th, right? Looking at this 61 and then selling out at that 63. That might actually only cost $1 to make that trade. So nice little momentum move here. Nice move on that 20-day and that 50. And I'm not looking for a huge move. I'm looking for just something that's going to generate hopefully somewhere in that 20 to 30% gain. And once again, if you break back down under that 20 and that 50, you get out of that trade. But everything lining up very nicely with the RSI, the MFI, the MACD, and the ADX, that positive crossover that happened 2 days ago, or happened back here, forgive me, on the 29th. That was yesterday. And now we are starting to see strength as this market opens again. DBX. Dropbox coming back above its 20-day moving average and hovering around. This convergence is very important because, once again, what we're looking for is the market to make a decision on the broader impact of technology stocks. Now that we're just kind of hovering around these lines, what we're looking for is a sharp move in one direction. So this sets up for either a straddle trade or we just simply wait and see what the Fed does, and we pick the direction that goes with Dropbox. Dropbox coming back off that sell-off that happened, and not a huge move down, right? Only moved about 26.50, but now pushing back above all three of those key moving averages and looking for continued strength. Console, CNR, popping back on as well. This is the coal trade. We continue to talk a lot more about this, but we're back above the 20 and the 50. This has retested its 200 before selling off. Same type of trade focus, right? You're looking for the move from one moving average to the other and just looking to exploit it and protecting yourself by utilizing spreads. All right. It is 9 o'clock and I'm getting texts. This is a very exciting time. All right. Cool. All right. Caesar. People keep asking me, when is this going to recover? I don't know. But I will say right now that I have said when we look at these directional moves, as I noted yesterday, when you get down under that 20 and that 50-day moving average, that's where you can be a little bit one directional, staying in the money, looking for that delta somewhere between 0.7 and 0.9. I had said in an email yesterday that I like to be around that 0.7 to 0.8 level. And once again, as you look at this $29 put, just trying to ride that momentum lower and just keeping a tight stop. This probably is not going to sell off down to the where we were back in April, but we're just looking for some additional technical breakdowns because, once again, the stock is falling under its key moving averages. And what's about to happen probably in the next 2 to 3 days is that the 20-day moving average will drop under the 50-day moving average. As I've noted, when it comes to momentum and we focus on these 4 different indicators, RSI has dropped under 50, MFI has dropped under 50, MACD has turned into negative, the histogram has turned wider, and the ADX showing that trend move that happened 2 days ago as we dropped under that 20 and that 50. So short ideas in this environment. Caesars remains interesting. I have noted there has been a lot of weakness and concerns in the regional banking space. This is kind of chopping around and hovering. As I said, if you're looking for a short on the regionals, just trade from one indicator to the next. Something as simple as the 62 to the 60 is one way to do it, and make sure that you keep a tight stop just in case this reverses and pushes back above its 20-day moving average. I will be avoiding the banks today because I just don't know how things are positioned ahead of time, but I would be paying very close attention to options flow on a lot of the banking stocks right now. On top of that, Netflix just continues to bleed off, and it's a very difficult situation for people who are trying to short this because the losses each day are just very small. So one of the things that can be very frustrating is that your time decay starts to erode. Even though the stock is showing more and more weakness, it's only dropping $3 to $4, it seems, a day on an $1,168 stock. So Netflix, even though it is moved lower, not a stock that I'm going to be touching, but I will just point out that Netflix's weakness is important given the fact that Amazon will be reporting earnings, and there is that relationship between those companies. And finally, ENPH, which I want you to keep on your watch list, because where this stock has been moving, and what's very unique and interesting about this, is you know that you have that bigger policy play here. Now, I'm not a guy who likes to draw lines and focus on it too much, but you can see that there has been this kind of downward channel that has been transpiring going back to December of last year. In addition to that, the stock has chopped up, touched its 50-day moving average, rolled right back over. So this stock is in this pattern of lower highs and lower lows. And what we're specifically looking for is for end phase to probably push off these oversold levels and look for another retest back of that 50-day moving average before rolling over. That is the current direction of the stock. That is the way that momentum has operated for this stock. And one thing that I continue to say is trade the trend until it breaks. So watch for end phase, possibility that we retest somewhere around, that we test around $30, and then actually looking for a reversal back up and testing contrarian play on that 50-day moving average. Today's watch list is SD. Oh, what do you do? Sandridge Energy. Some of these names that just kind of pop up only when oil prices and energy remain stronger. Sandridge popping back above that 1060 level. Interesting. Don't know much about the company, but it did pop up on the watch list. ARCC, which is one of my favorite BDCs in the world, is back in focus today. This is one of those names that if you are looking for an opportunity and for a way to take advantage of long-term capital appreciation, long-term income, dividend reinvestment, this needs to be on your watch list, because if this stock gets back down to around that 200-day moving average, that would be a place to continue to build a position over time. Microsoft Meta, obviously in focus today because of earnings, and we will look to be active in trading those tomorrow on the backside of this. But those earnings after the bell today, you're going to see some positioning. Very good opportunity to be trading volume-weighted average price around these names. All right, let me jump into the chat real quick, see if we have any questions, make sure that we are keeping up. You guys are doing a great job keeping one another active. Don is on the dance floor with KRE. I believe it. He's going to be the first guy over the wall. He's going to be the first person right through the wall. I appreciate that. Want to know exactly where I need to be watching capital flow ahead of a day like this. All right. How about a new thing we're going to create? Yesterday we talked about baseball cards. Today we're going to talk about, wait, what? Dr. Ed Yardeni. And if you don't know who Dr. Ed Yardeni is, one of the great macroeconomists in the world, has a great blog. Definitely a person who, when he pops up on the radar of Barron's and other major financial media outlets, you got to pay attention. He's like Hartnett at Bank of America. You always want to be paying attention to what these guys are saying, particularly around liquidity. And even though some of these predictions are somewhat insane sometimes, right, from some people in the markets, I'm not going to make any comment about the perma bull, but this is an interesting number that came out because it's grounded in logic. And in the final years of the decades pan out as expected, Dr. Ed Yardeni believes that the S&P 500 price index may be around 10,000 as the 2030s begin. What do you guys think? Where do you think the S&P 500 is going to be on January 1st, 2030? I'll give you a moment to figure that out, and I will play the Jeopardy level. All right. I don't disagree with that, but Yardeni was one of the more aggressive people in the 2023 period where he came out and said, look, capital's expanding, markets are going to move higher. He was very obvious on that 6,000 call last year. He was right. He was one of the very few people. Somebody's saying 1,000. All right, so let me walk you through this and explain. The reality is this is something that can happen, and there's a reason for it. Liquidity, which continues to expand at a breakneck pace. And I want to point something out just looking at the SPY. Let's just go to the monthly chart from this move that has been transpiring over the last couple of years. As I have noted, the financial structure of the entire U.S. financial system adjusted in 2017. And specifically what happened in the wake of the Tax Cuts and Jobs Act, the United States government started to shift the way that it was financing itself into shorter term T-bills. Now, why does that matter? T-bills are bills that are a form of borrowing by the U.S. government that are 12 months or less, right? You have a couple of weeks, you have 13 weeks, 26 weeks, 52 weeks. But here's the thing. Those bills, we had only done about 11% of our borrowing in T-bills. Today, we're up to about 22%. That number is expected to expand to 25%, according to Bank of America, based on the new One Big Beautiful Bill. And allegedly, President Trump recently came out and said, you know what? Let's just borrow everything in T-bills until interest rates come down and we refinance the debt. Now, why does all of this matter? As I've noted, when it comes to the financial system, T-bills are very, very liquid assets that have the capacity to allow institutions to lever up using the combination of the basis trade and to go out and turn a $100 million fund into a $2.5 billion leveraged position. And once again, at the net level, probably around 2 to 3 or maybe even 4 times leverage. The issue with stuff like this, though, is that they're leveraging up on bonds and they're leveraging up on stocks. When things go wrong in the financial markets, particularly as they did with April and what they did last year with the Nikkei crash and what they did with the gilt crisis, is that when everything goes awry, everything starts dropping together. The correlation goes to 1. And what does that mean? It means stocks go down and bonds go down. And that creates the contagion that can ultimately lead to crisis, which forces the central banks to step in and to be more accommodative and effectively change their positioning and just lead this market higher once again. I will note that the SPY was only at 238 in 2017. It is at 635 now, right? That is manic, the type of move that has transpired in just under 9 years. So when Yardeni is saying, yeah, we could be at 10,000, the liquidity cycle is expected to continue to expand. The focus on the leverage and the T-bills is expected to expand. And then you have these other components of growth and the idea of, will AI help fuel an economic boom as well? The liquidity cycle, as I have laid out and explained based on the work of Michael Howe, we have seen going back through these periods of time, liquidity cycles rolling on around a 6-year basis. We bottomed out at around 2013. We had a big, 2019, we had a big expansion on the backside of COVID. We had a bottoming in that cycle back in October of 2022, and we have been expanding since. So at some point, this is going to cool off. It is likely going to happen sometime in the 2026 or 2027 period based on current estimates. But eventually, what will happen is you're going to see another type of this event that transpires where the broader market sells off because of concerns about all of the refinancing of the $300+ trillion in the global economy in debt that needs to be refinanced on the back of only about $180 trillion in liquidity and capital. So we'll get that sell off, and then what's going to happen? Well, as a result, you're going to have to end up seeing the United States and the Federal Reserve and other central banks become more accommodative one more time, and that is likely going to push equities and risk assets even higher. It is based on cycles. It is based on basically almost on like solar cycles, the way that some of this operates. But that has been my thesis for a very long time. This has been the basis of the academic work that I've done for a very long time. And I encourage you to watch what I have called the wave speech, which is a breakdown of my thesis on how the markets actually operate. We'll put that video in the chat in a moment, but overall, the expectation here is that we're going to continue to see more capital expansion, more monetary inflation, and all signs actually pointing to a generational buying opportunity, in the words of the great Gianni. All right, one last thing. Again, we go back to something that Secret Agent Charlie was talking about. Team Powell. Secret Agent Charlie knows the score. Powell is up once again. We get a little bit of a rebound coming off of that move on the 20-day moving average. And PALL, as I've said, this is going to be very beneficial. There he is. He's all Team Powell up in here. Love it. Once again, Palladium. I really like this long-term chart. I've said it multiple times. I'm going to say it another 50 times. What I'm trying to get here is through the wall of the 121 level. But once again, big changes in the global automotive sectors, the policy changes that have been enacted by the Trump administration, the expectation, once again, that the catalyst converter will reign supreme for a long time and that the EV transition slowing down. This has become an opportunity. So if you are not in this yet, if you haven't taken this trade, I would encourage you to be a little bit patient. And what my recommendation and my focus would be is to wait until you get to the 121 level. You want to follow that momentum. And this is an adjusted EMA on the monthly. So we're going out pretty far. Either you wait for a move back down to where I had entered it somewhere around the $100 level, or you wait for momentum to take you through, and that becomes your stop. That becomes your stop. Pretty simplistic. But once again, really like these types of charts where you see a massive move the way that we have moved. And this is one of those little things that I look at the outside and I say, all right, I either want to re-enter it at the 20-day moving average, or I want to look at the long-term moving averages that are in play as well. Just rocking Palladium. Love it. Copper. Well, the thing that's interesting about copper, and we're seeing that support at that 20-day simple moving average. The thing about copper that's unique is that you have to go back and you have to pay very close attention to what the People's Bank of China is doing. Because as we've noted, when the Federal Reserve is accommodative here in the United States, when they cut interest rates and when they engage in quantitative easing, that is beneficial to banking stocks, right? So go back to any of the Silicon Valley banking crisis and anything else that has occurred. That is that's that accommodation. On the copper side, that is where central banking policy out of China is very, very critical. So copper finding this level of support at 561, I'm going to be very candid. I think that we're going to have a liquidity event in the next couple of years, and that'll obviously impact copper prices the way that we saw back here in April or we saw back here in August. But I'm of the belief, as many other people are, that we're going to have supply issues in the future, trying to electrify everything, all of the AI centers, all the costs that are associated with it. There is a bullish case and a rational case for copper to be up at the $6, $7, even $8 level. But for right now, I just continue to advocate that you follow the momentum And if you see these moves that are under these key moving averages, you just have to be a little bit wary because there's probably something in the background that you might not know about. Once again, this is so heavily driven by policy changes globally that this can break down very quickly in the event that the U.S. and China relationship fizzles over the next 12 days. Just keep your focus around these moving averages. Yes, Walter, thank you. So once again, if you haven't read it, and in the argument that I've made around the monetary inflation, that's called the next 36 months. I'll put that in the chat right there. And that, just so that everybody understands, that actually happened when I wrote this piece, interestingly enough, the same day that momentum changed. So this was around April 24th, and we started to see strength in materials and healthcare at that time. But the entire point that I'm making here is that monetary expansion is going to be the trend for the foreseeable future. And if you look at this very specific chart that comes from Howe, we're probably up here somewhere in the liquidity cycle. We will look to peak next year. And as I've said, if you're just paying very close attention and trying to navigate these markets, all you really need to do is just be paying very close attention to the FNGD to see whether or not there is leverage potentially leaving the broader markets in those S&P 500 stocks, those big names that dominate this market the way that they do. I believe it's somewhere around the line of like 39%. I think like the top 8 or 9 stocks are now like 39% of the S&P 500, which shows you that investors, particularly the RIAs and the money managers, have no imagination. They are simply trying to follow what the herd is doing because they are so heavily tied to the S&P 500. I want to remind you, if you manage an ETF or you manage a fund or you're managing private money, you are not measured on whether or not you were up or down on the S&P 500 this year. You're measured on the benchmark, and your benchmark is traditionally the S&P 500. So instead of actually trying to beat the S&P 500, what all of these managers end up doing is just buying all of the exact same stocks. And then they just tell their customers, hey, we're just replicating the market performance. We're not buying the SPY. We're buying all of these companies so that we don't have to pay these associated fees. It's a little bit of a game. So I just continue to remind you that, if you're looking to pay, this is a market that has really become a lot simpler since COVID because of the way that the technicals have operated. Just be very wary if and when the S&P 500 does drop under its 20 and its 50-day moving average, because obviously all of the crises and all of the challenges and all of the worries have transpired under those levels. And don't be afraid to be very one-directional and speculative in the event that the market does go that wrong way. We'll be paying very close attention to the FNGD, but if the FNGD starts to break those moving averages, then you can speculate on a very cheap $100 call on something like the SPXU, which is a triple leveraged ultra short S&P 500 ETF. And then all you're doing is trying to bet a buck to make 20 to 30. These are the types of moves that the black swan style investors focus on, like people like Taleb and Universa. They're looking for these events to transpire because these big multi-sigma events seem to be happening more and more. But the point that I'm making right now is don't try to do it right now. Just wait a little while. And when we start to see these moving averages break, that's your time to take aim. That's your time to short. That's where you can have conviction and a little bit higher probability. And if it comes, it comes, and it's going to pay very well. If it doesn't, well, you keep a very tight stop back at these moving averages. I don't like about MMs is that they sell into weakness and buy into strength. Also, they are short-term oriented for the sake of shit. Correct. Yes. Rosario, your concern is noted. Would you then play FNGD or just use it as an indicator? The FNGD is not something that I will actively trade. It is the indicator that I am utilizing for the purposes of recognizing if there is something significant happening. And one of the ways to trade it, SPXU, you can buy the SH, which is an inverse ETF around the S&P 500. And the other nice thing to note is that there are inverse funds around the Russell 2000 as well, because Russell 2000 momentum is very, very similar. Russell momentum the Russell 2000 is really a better reflection of the U.S. economy, while the S&P 500 is more of a global index that is telling us about the state of liquidity right now. So 9:20. I hope you guys are having a great day. If you are not a member of the Tesla Mastermind, just going to let you know that there's still obviously always time to join it, catch up on what we're focusing on. But we are going to be actively trading in that room today from about 2:15 until 4 o'clock, just trying to make some moves as the Federal Reserve wraps up. Don Kaufman, everybody, is going to be coming up, throwing on some music in a minute, telling me to get out of the room so that he can play his jams. I hope everybody has a wonderful day. Thank you so much for your time as always. Looking forward to seeing you guys again tomorrow at 8:45. Market Masters. Take care, everybody.